Welcome to Talk Tickers. On this deep dive, we are covering a really interesting financial topic.
Yeah, it's one of those things that seems small but actually rewires everything.
Exactly. We are diving into fractional share investing. Basically, how the ability to buy a microscopic slice of a stock has just completely upended the financial markets.
It really has. I mean, it changed the fundamental architecture of who gets to play the game.
Right. And to really unpack this, we are looking at a pretty massive stack of information today. We've got a comprehensive academic study from the TCU Neely School of Business. We're looking at regulatory guidance from NRA.
Which gets pretty deep into the weeds.
Oh, very deep. Plus, we have the actual back-end brokerage mechanics from platforms like Bigjit and Option Alpha, and some really sharp financial commentary from Forbes and Do.
Yeah, pulling all those together gives us a picture of not just what's happening on your phone screen, but the actual invisible plumbing beneath it all.
Exactly. That's our mission today for you, the listener. We want to show you how this changed, who gets to invest, reveal that hidden plumbing of how brokers actually pull these trades off, and look at the ripple effects.
Including the really volatile ones.
Right, like fueling those massive meme stock bubbles. So, okay, let's unpack this. We have to start with the barrier that existed before fractional shares, the problem of the whole share.
Yeah, the old velvet rope of Wall Street.
Right, because I want you to imagine, like walking onto a car lot. You need a car to get to work, you find a decent sedan, you check your bank account, and you tell the dealer you have the cash ready.
Makes sense.
But the dealer just shakes his head and says, sorry, we don't sell individual cars to individual people. By law, you have to buy the entire fleet of 50 vehicles, or you're walking home.
Which is completely absurd in the real world.
Exactly. But for over a century, that was basically the psychological and financial reality of the stock market. You had to buy the whole thing.
Right, because, well, to understand why that barrier existed, we have to look at the physical history of the market.
The actual paper certificates, right?
Exactly. For decades, trading a stock meant exchanging a literal physical piece of paper. The whole infrastructure, the vaults, the couriers, the transfer agents, it was all built around handling discrete, indivisible paper units.
Because you obviously can't just rip a stock certificate in half and hand it to someone.
You can't. And that physical limitation became hard-coded into the digital architecture. The National Market System, or NMS, which governs how U.S. exchanges operate, was coded to only recognize whole numbers.
Integers only.
Right, no decimals allowed. So even when we moved to electronic databases, we basically carried the ghost of that physical paper with us.
That is so wild. The system was just rejecting anything less than a whole unit. And if you look at the commentary from Forbes, they point out how this created a massive barrier for everyday people.
Oh, a huge barrier.
Because it wasn't just about buying one share. Traditionally, you had these high minimum balance requirements. Like a decade ago, you might need $1,000 or even $5,000 just to open a basic brokerage account.
Just to walk through the door.
Exactly. And then once you were in, you faced the share prices of these blue chip companies. I mean, think about Berkshire Hathaway Class A shares, right?
Yeah, hovering around $500,000 for one share.
$500,000. Or pre-split Amazon and Google trading well over $2,000.
Yeah.
If you only had a few $100s to your name, you literally could not own a piece of the companies reshaping your everyday life.
And the irony there is so thick. The people spending their disposable income on like Amazon Prime or Apple devices were structurally blocked from participating in the capital growth of those exact same corporations.
They were funding the growth as consumers, but locked out as investors.
Right. They had the desire to invest, but the system just lacked the granularity to accept their capital.
But then we hit this massive turning point. And the dam didn't just break. It basically evaporated over like 8 months in 2019 and 2020.
It was incredibly fast.
Yeah. We saw this sequential aggressive rollout of direct fractional trading. Interactive brokers started it in November 2019. Robinhood jumped in a few weeks later.
Which is when it really hit the mainstream.
Right, because they already had the millennial audience.
Yeah.
Then Fidelity, this absolute titan of the old school brokerage world, they joined in January 2020. And Schwab by June.
Though Schwab initially restricted it just to S&P 500 stocks.
True, but this wasn't happening in a vacuum, right? This rollout collided with another massive structural change.
The race to zero commissions.
Yes. Talk about that, because that seems like the actual engine making this possible.
This is a mandatory prerequisite. Fractional trading literally cannot exist without zero commissions.
Because of the math.
Exactly. Think about a legacy broker charging a standard $10 fee per trade. If you want to buy $5 worth of stock and you pay a $10 fee, you are instantly down 200% the second the order fills.
Wow. Yeah, the stock would have to triple just for you to break even.
Right. The math of microscopic investing only functions if the friction of fees is completely removed.
Okay, so you have zero commissions and the new fractional plumbing, and then the ultimate catalyst drops the COVID-19 pandemic.
The perfect storm.
Truly.
Yeah.
Suddenly you have millions of people stuck at home, no live sports, no going out.
And governments injecting direct cash into the economy through stimulus checks.
Yes, unprecedented spare time and spare cash. And this created a demographic shift that is just staggering. The SEC data on Robinhood from 2021 shows their median account balance was just $240.
Which is fascinating. Under the old rules, $240 wouldn't even cover the minimum deposit.
Let alone the commission fees to build a diversified portfolio. But suddenly, empowered by these fractions, this low capital demographic is actually exerting real influence on global asset prices.
And it highlights a massive generational divide.
Yeah, the Do article had a great stat on this. It noted that 86% of Gen Z learns about personal investing before they even enter the workforce.
Compare that to baby boomers.
Right, only 47% for boomers. Gen Z isn't waiting to sit down with a guy in a suit in a mahogany office. They're learning on TikTok and trading on the bus.
But if we connect this to the bigger picture, there is a very valid critique here.
Right, and I actually want to play devil's advocate for a second, because Forbes brings up a really cynical mathematical point.
Let's hear it.
Let's say I'm 19. I buy $5 of NVIDIA on an app, and I get incredibly lucky and time 100% gain.
You doubled your money.
Right, I made exactly $5. I can buy a latte. So the question is, does buying $5 of a tech stock actually build real wealth? Or does it just create this false sense of financial security?
It's a fair question. The absolute dollar return on a $5 investment is objectively negligible. It's not going to fund your retirement.
No, it's not.
But focusing purely on the math of that first transaction misses the behavioral economics entirely. It misses the concept of micro-consistency.
Okay, micro-consistency. Break that down.
Historically, the advice was always to save up your money in a bank account until you reached a meaningful threshold, maybe $500, and then deploy it into the market.
Right, the old lump sum approach. But human nature makes that so hard. If I have $300 sitting there waiting to become $500, my car breaks down, or I see something I want to buy.
Exactly. The friction of waiting gives consumption time to cannibalize your savings.
The lump sum just never actually happens.
Right. Fractional trading fundamentally changes that behavioral role. It lets you allocate $20 into the market the exact minute your paycheck clears every single week.
Oh, I see. So it takes investing from being this scary high-stakes chore and turns it into a low-stakes digital habit.
You are building the muscle memory. You learn how to stomach market volatility when the stakes are just $20 instead of panicking when your entire life savings drops by 5%.
That makes total sense. The wealth isn't the $5 you made. It's the behavioral rewiring that ensures you do it 500 more times.
Because compounding requires time and consistency above everything else.
Okay, so behaviorally, it's brilliant.
Yeah.
But let's look at the actual mechanics. Because what you see on the app is kind of an illusion.
It's entirely an illusion.
Right. Let's pull up the floorboards and look at the hidden plumbing. We just said that the public stock exchanges absolutely do not trade half shares. They only speak whole numbers.
Correct.
So if the exchange rejects fractions, when I look at my phone and hit buy on 0.25 shares of Apple, what exactly am I buying?
You are buying an internal accounting construct managed entirely by your broker. The magic happens strictly on their back end.
So the broker has to translate my fractional desire into a whole share reality. And the guides we have from Option Alpha and Bidget detail 3 distinct models for how they do this.
Yes, the 3 execution models.
Let's break these down, starting with aggregation. The way I picture this is like a bartender taking orders for a pitcher of beer.
That's a good analogy.
Right, so you want a glass, I want a glass, someone else wants a glass. The bartender doesn't go to the keg for every single order. They wait until there are enough orders to justify a whole pitcher, they get the pitcher, and then pour out our fractions. Is that really how that contract works?
It operates on that exact principle. The brokerage pools thousands of tiny fractional orders from retail clients. You want 0.2 shares, I want 0.5, someone else wants 0.3.
And they mash them together.
Right. The algorithmic routing system aggregates them into one whole share, routes that to the open market, and once it fills, their internal database just distributes the fractions to our accounts. But wait, isn't there a risk there? If I order my beer at 10 a.m., but the bartender waits until 10:15 to fill the pitcher because they needed more orders, the price of the keg might have gone up.
Exactly. It's called temporal slippage. The broker have to hold the orders until they form a whole unit, and the asset price can fluctuate during that delay.
So you might get a slightly worse price just because you were waiting on other fractional buyers.
It's a small inefficiency, but it's real.
Okay, model number 2 is internalization. Now, here, the broker doesn't go to the public exchange at all, right? They just fill it from their own inventory.
Correct. They fill the request directly from shares they already hold.
And I have to push back on this because that sounds shady. If I want a quarter share of Tesla, and the broker just sells me a quarter of their own Tesla stock, aren't they basically taking the other side of my trade?
They are acting as a principal in the transaction, yes.
But doesn't that create a massive conflict of interest? If I lose money on my fraction, does the broker just pocket the difference? You're hitting on a core regulatory tension. When they internalize, they assume the market risk of holding that inventory. But regulators watch this very closely.
I would hope so.
Under NMS rules, brokers are legally obligated to provide national best bid and offer, or NBBO, meaning they must fill your internalized order at a price equal to or better than the best available price on the public exchanges.
Even if the trade never actually reaches the public tape.
Exactly. FINRA is constantly monitoring to ensure they aren't manipulating execution prices to pad their own profits.
Okay, well that leads us to the third model, which is even weirder. Synthetic ledger entries. With aggregation, they buy a new share. With internalization, they use a share they already own. But with synthetic ledgers, you aren't really buying the asset at all, are you?
Not directly, no.
It sounds like buying the concept of a racehorse without actually owning the horse. The broker keeps the horse, their name is on the deed, and they just have a spreadsheet promising you 10% of its winnings.
That is the defining feature, the separation of custody from economic right. A master custodian, like a major bank, holds the actual whole shares. The retail broker just holds an omnibus account with them.
So when I buy my fraction,
You're just getting a pro rata ledger entry on the broker's internal database. Your ownership is entirely derivative.
and the precision of this record keeping is just insane. The guides note that brokers offer these fractions down to 3 or even 6 decimal places.
Yes, incredible precision.
Like buying 0.000001 shares. You're buying 60 cents of a company. But why does that level of decimal matter to anyone besides the app developers? Why did Fractional have to issue specific guidance on 6 decimal places?
It all comes down to market transparency. Broker-dealers have to report their trades so regulators can monitor the health of the market. But before fractional trading blew up, the reporting systems couldn't handle high-precision decimals.
Oh, so if a broker traded to 6 decimals, the system would just round it off.
Or trumpate it entirely. Millions of microtrades were generating volume that regulators simply couldn't see accurately. So FINRA had to force firms to upgrade their reporting protocols to capture everything up to 6 digits.
They needed to make sure the invisible plumbing was actually visible to headquarters.
Exactly, to detect manipulation or systemic risks.
But this highly synthetic plumbing creates a huge trap for the investor, the nightmare of vendor lock-in. And I don't think most people realize this until it's too late.
It is a brutal realization for many.
Let's paint a picture. Say I've been buying fractional shares of Apple on broker A for 3 years. I have 10.5 shares. But I decide I hate their app and I want to move my portfolio to broker B.
Which you used to do easily with the ACS system.
Right, automated customer account transfer service. But if I try to move my 10.5 shares today, what actually happens to the fraction?
The ACS system only operates on whole shares. Because your half share is just an internal ledger entry specific to broker A, broker B's database cannot accept it.
So they can't transfer it.
Nope. They will transfer the 10 whole shares, but they are forced to liquidate that remaining 0.5 share, convert it to cash, and transfer the cash.
Which triggers an immediate forced taxable event.
It absolutely does.
That is awful. If I've been dollar cost averaging into an index fund for years and I own fractions of hundreds of different companies, changing brokers means selling off every single fractional piece.
You could get hit with hundreds of unexpected capital gains tax liabilities.
Just for trying to switch apps, it completely removes your control over the timing of your own taxes.
It is a significant unadvertised cost. And the synthetic ownership also messes up corporate governance, specifically voting rights.
Right. If I own a whole share, I get to vote on the board of directors. What happens if I only own a fraction?
It's highly inconsistent. Some brokers will aggregate all the fractions and vote on your behalf, but many explicitly state in their fine print that fractional shares carry no proxy voting rights whatsoever.
So you get the dividends, but you're locked out of the boardroom.
You provide the capital, but you forfeit the voice.
Wow. Okay, let's zoom out from the individual level. I want to talk about the macro level, because the TCU academic study has some incredible data on how these tiny trades aggregate and physically move the market.
Yes, the ripple effect.
Because before fractional shares, retail investors suffered from this psychological quirk called the nominal price illusion.
Which is a well-documented cognitive heuristic.
Right. Basically, investors confuse the nominal price of a single share with the actual value of the whole company. If you have $500, you psychologically prefer to buy 100 shares of a $5 stock rather than a tiny fraction of a $2,000 stock.
It's the illusion of volume. The human brain wants a round lot. It feels more substantial.
It feels like you're a serious investor if you own 100 of something. But the reality is, a $5 stock is usually priced at $5 for a very bad reason.
Exactly. It's a penny stock. It's probably a failing company, highly illiquid, or a pump and dump scheme.
So everyday people chasing that dopamine hit of 100 shares were dumping their savings into the absolute worst garbage on the market.
And historically experiencing terrible long-term returns because of it.
But the TCU study points out that fractional trading largely cured this. When you can just type $50 into an app and buy a slice of Microsoft, you stop thinking about share quantities.
The interface trains you to think 100% in dollar amount.
And suddenly, all this capital that was trapped in the penny stock casino flooded into high-priced, high-quality stocks.
It was a massive reallocation of capital, but tracking it was tough for the researchers. Because if these trades are aggregated off exchange, how do you mathematically prove retail money is flooding into these assets?
Yeah, how do you find an invisible trade?
They used a brilliant proxy. When brokers aggregate fractions and execute the whole share remainder off exchange, it's reported to the tape as a one-share trade.
Oh.
The researchers figured out that these off-exchange one-share trades perfectly map to fractional trading activity.
Like breadcrumbs.
Exactly. And by tracking those specific prints, they saw an absolute explosion of tiny trades following the rollout of fractional platforms.
And crucially, that surge was concentrated in high-priced stocks with low institutional ownership. The exact stocks retail investors used to be locked out of.
The barrier was breached.
But here's where it gets really interesting. Because giving retail investors access to good companies is great. But we live in the era of financial TikTok, FinTok, and Wall Street bets.
The chaos factor.
Right. What happens when you mix frictionless access with the viral attention of millions of people pointing their phones at the exact same high-priced stock?
You trigger what the literature calls attention-induced price pressure.
Break that down.
Well, the apps themselves fuel this. Think about the top mover lists on these platforms.
Oh, yeah. The leaderboard's showing what's spiking right now.
It's essentially an algorithmic neon sign designed to trigger FOMO. And because price is no longer a deterrent, if a stock on that list is trading at $800, a kid with $40 can still swipe up and join the herd.
And since retail investors mostly buy rather than short sell, it creates this massive, unnatural wave of pure buying pressure.
Exactly. But the data shows the herd usually gets punished.
How so?
When a high-priced equity gets this sudden surge of retail attention, the buying pressure artificially forces the price way above its fundamental value. This is the price overshoot.
But it's unsustainable.
Right. It's driven by social media attention, not fundamentals. The second the viral cycle moves on, the buying volume evaporates.
The air leaks out of the balloon.
And the study shows these stocks see lower returns by 7 to 15 basis points over the next 5 days compared to low-price stocks under the same conditions.
Because the early adopters pump the price, the fractional herd provides the exit liquidity, and the latecomers get left holding the bag.
Exactly. It reverts to its actual value, and people lose money.
That is the dark side right there. But this mechanism leads us directly into the ultimate manifestation of this. We have to talk about GameStop in January 2021.
The defining market event of the modern retail era.
Let's look at the timeline. January 25th, GameStop is around $77. 48 hours later, it hits an intraday high of roughly $348.
There's historic squeeze.
But remember the math paradox from earlier. The median Robinhood account was $240. Under the old rules, once GameStop crossed $250, the rally should have died instantly.
Because they literally wouldn't have the capital to buy a single share.
Right. A concrete ceiling should have stopped them. So how did it keep rocketing toward 400?
Because fractional shares completely removed that natural ceiling. The integer didn't matter anymore.
And the TCU study proved this, right?
Yes. They used GameStop to validate their data. When they plotted the percentage of those tiny one-share trades against GameStop's skyrocketing price, it tracked perfectly, step for step.
So even at $340, a guy with $30 left in his account is still buying 0.08 shares, just throwing gasoline on the fire.
The natural friction of high prices was obliterated.
But to understand how the fire got so big, we have to look at how Wall Street reacted. The feedback effect model, specifically the Goldstein feedback mechanism. Let's walk through this because it explains how a meme basically alters reality.
It's a fascinating 4-stage loop. Stage 1 is what we just talked about. Speculators, the retail herd, buy in aggressively based on social media, driving the price up.
Okay, retail noise pumps the price. Stage 2.
Stage 2 brings in the institutions. Banks and big investors watch stock prices to judge a company's health. A rising price usually means the market discovered positive fundamental news.
The market knows something we don't.
Right, but because fractional trades are aggregated into full shares on the tape, institutions can't easily tell the difference between smart money accumulating and a synthetic meme frenzy. They misinterpret the noise as a valid signal.
Wow, the algorithms get completely fooled by Reddit.
Which triggers stage 3. Because the banks view the company favorably now, they alter their behavior. They extend favorable credit, or most importantly, they help the company issue new shares.
Right. The company realizes its stock is wildly overvalued, so they sell millions of new shares directly into the meme frenzy to raise billions in cold, hard cash. GameStop and AMC both did this.
Exactly. And that cash finalizes stage 4. The firm's actual fundamental valuation improves because of the capital injection.
The meme literally saves the business.
Yeah.
They pay off their debt with the cash they raise from the hype.
And when the market sees the improved balance sheet, it prompts even more speculation from retail. Look, we were right all along. And the loop starts again.
It's financial alchemy. But it creates terrifying systemic instability. Did the study quantify the bubble risk of this new plumbing?
They did, and it's highly disruptive to traditional risk models. They defined a massive price bubble as a 150% peak, followed by a 40% crash.
Okay.
Since the introduction of fractional trading, the likelihood of a high-priced stock experiencing one of these massive bubbles is 27% higher than for a low-priced stock.
A 27% increase in bubble risk, just because people can buy $5 slices. If you're managing a retirement fund full of blue chips, you now have to factor in that your stable assets might get hijacked by a meme loop.
They are no longer insulated by their high share prices.
Now, we've focused a lot on retail day traders, but Wall Street always adapts. Let's look at the advanced strategies because institutions figured out how to use this for the ultra-wealthy.
Yes, specifically direct indexing.
Right, based on the finite resources. How does this work?
For decades, if you wanted exposure to the S&P 500, you just bought an ETF. One click, done. But an ETF is a commingled vehicle. You own a share of the fund, not the underlying stocks.
Okay.
With zero commission fractions, wealth managers bypass the ETF. Their software automatically buys microscopic slices of all 500 individual companies, recreating the index directly in your account.
But wait, if an ETF is so easy, why execute 500 separate fractional trades? What's the actual advantage?
Tax loss harvesting.
Walk me through the math on this because this is usually billionaire stuff.
Say the market is up 10% for the year. You have a capital gain. But underneath that, maybe 100 of those 500 companies actually lost money.
Right. Not every stock goes up.
If you hold the ETF, those losses are trapped inside the fund. You can't use them. But with direct indexing, your algorithm sells the specific fractional shares of those 100 losing companies.
Which locks in the losses.
And the IRS lets you use those realized losses to offset your gains. So you pay significantly less in capital gains taxes.
While the algorithm immediately buys similar stocks to keep your portfolio balanced, it is the ultimate Wall Street judo move. Weaponizing plumbing meant for 19-year-olds into an aggressive tax shield.
Exactly. But speaking of those 19-year-olds, we have to look at the regulatory fallout of all this access. The influencer trap.
Yes, the Dew article had a really sobering stat. 37% of Gen Z investors report falling into financial difficulties because of social media advice.
The acceleration of access completely outpaced financial literacy.
Scams, margin calls, IRS audits, which is why the SEC and FINRA are cracking down on regulation best interest, or Reg BI. What are they actually hunting for?
Obfuscated conflicts of interest, like payment for order flow or PFOF. When a broker internalizes your order, they're often compensated for routing it a certain way, which conflicts with their duty to get you the best price.
And FINRA is also looking at the marketing of complex products, right? Because the velvet rope is gone.
Right. Retail investors now have fractional access to leveraged ETFs and inverse volatility products. These are institutional instruments that suffer from mathematically guaranteed volatility decay.
Let's explain volatility decay really quick because this ruins people. If I buy a 3 times leveraged ETF and market drops 10%, my ETF drops 30%.
That's correct.
If the market goes up 11% the next day, it recovers its original high. But my leveraged ETF only goes up 33% from its new, much lower baseline. I never get back to even. The math forces it to decay.
But a kid watches a viral video hyping the upside, buys a $50 fraction, and holds it for 6 months, completely unaware that the math is eroding their principal.
Which is terrifying. But even with plain vanilla stocks, the apps themselves create a behavioral trap over trading.
Gamification. Confetti, push notifications, no fees. It trains you to constantly tinker.
Buy a $10 fraction today, sell for 11 tomorrow. And that is toxic for 2 reasons. First, retail investors are terrible at market timing. You're just destroying your long-term compounding.
But the second reason is much worse. The wash sale rule.
Yes. This is the IRS nightmare. Let's walk through the trap. Say I buy $100 of Tesla, it drops, and I panic sell at $80. I have a $20 loss.
Which you think lowers your taxes.
Right. But 2 weeks later, I see some good news, and I buy a $5 fractional share just to get back in. What did I just do?
By repurchasing the asset within 30 days of the loss, you triggered a wash sale violation. The IRS disallows your $20 loss entirely.
I can't claim it at all.
Nope. Instead, it gets added to the cost basis of your new $5 fraction.
Oh my God. So if I am day trading $5 slices of 20 different companies based on push notifications, I am triggering hundreds of these violations.
You are building an accounting labyrinth of disallowed losses, and you won't know until February when your broker sends a 100-page tax document.
The friction of a $10 commission used to force you to stop and think. Now you can casually swipe your way into an IRS audit from your couch.
It's a very real danger.
Okay, let's pull all this together. Fractional shares have undeniably democratized the market. They let any $1 cost average into blue chips and cured the nominal price illusion that kept people in penny stocks.
And they open up advanced strategies like direct indexing.
But the lack of friction comes with huge hidden costs. Vendor lock-in, the magnification of meme stock bubbles, the 27% higher bubble risk, and the nightmare of wash sale taxes.
It's a double-edged sword.
So we turn it over to you, the listener. Take a hard look at your own portfolio. Are you using fractional shares to build a disciplined base? Or are you getting caught in the gamification, chasing tickers and providing exit liquidity for a social media pump and dump? Are you building wealth or just playing the game?
And as you think about that, consider one final broader question. If fractional trading successfully trains an entire generation to think exclusively in dollar amounts, completely abandoning share quantities, will the stock split eventually become completely obsolete? If no one cares how many shares they own, will the very concept of a whole share eventually vanish entirely, leaving it as just a back-end accounting relic?
Wow, the literal death of the share. That is a fascinating thought to end on. Thank you for joining us today on Talk Tickers as we unpack the hidden plumbing and massive ripple effects of fractional investing. Keep asking questions, keep digging deeper, and we will see you on the next deep dive.